Justin, thanks very much for joining us. Looking at the sectors, I suppose, how do you see the outlook and likely recovery for areas like hospitality and retail?
The hospitality segment in the US is already seeing a resurgence in demand for leisure travel. It's been very domestic or short haul focused, and I think that's a dynamic that we're expecting to play out here in Europe as these economies start to reopen. But I think that will be swiftly followed in a couple of years' time by renewed business travel. And as we get more of the globe reaching herd immunity, we can start reintroducing long haul and large business travel and conferences. So I think within the hospitality segment, we'd expect the leisure travel and the more domestically focused tourism to really lead out of the gates. And I think that will be a pretty swift recovery because I think there's some strong pent up demand that we're already seeing happening in the US. I think on the retail side of the equation, COVID-19 will likely be looked back upon as a big accelerator, an accelerator of the dynamic and the discussion that has long needed to be had between landlords and retailers. You know, the e-commerce story has been around for 5, if not 10 years, and it's been a real pressure point for retailers' profitability. They've had to invest in supply chains, invest in inventory management systems, build out that winning omni-channel business model that's been a huge drag on their profits. At the same time, cost pressures and competition have been an issue for the revenue side of their equation. So profitability has been a big concern in that segment, and I think the COVID-19 pandemic has just exacerbated that. Luckily, the fiscal support from governments has been there, and I think it's accelerating the needed discussion to kind of right-size the rents, right-size the store networks, and get something more sustainable from an overall business model that aligns the bricks and mortar with the online presence to allow for that omni-channel business model. And the rent overage situation that we've had over the course of the past 5 to 10 years get right-sized to a more sustainable NOI level that is, you know, something that can then be underwritable from the capital market standpoint going forward.
And in terms of the outlook for capital, Justin, how do you see the comparative attractiveness of real estate as an asset class?
I think this low interest rate environment, even if we're seeing a rise in interest rates over the year-to-date period, it's important to remember that the rise in interest rates does not equal a high interest rate environment. You know, where we stand today is back pretty much to where we were at the start of the pandemic. This low interest rate environment remains very conducive to real asset investment. I think we've got an outsized yield spread relative to these government bond yields and even some of the corporate bonds that will continue to be attractive for institutional investors around the world. And as a consequence, I think the capital side of the equation will continue to be supported by the wider financial markets. And I think the real focus going forward is going to be on the income side of property performance. The mega trends, the overall thematics, I think will continue to be a short-term focus. So areas like residential or the wider living segment, the logistics market, and increasingly some of these other alternative and burgeoning areas, such as life sciences, something that's very well established in the US is continuing to grow here in Europe with a rapid rise in venture capital spending that's coming into the European landscape. I think that's another attractive area that's got some of these long-term structural demand drivers behind them, just like data centers and the digitization megatrend. You know, those are definitely some of the defensive segments that have been the focus of our activity over the course of the past 3 to 5 years, and I think will remain a focus over the short term. But I think as we look beyond that short term and into the medium term, we can start look at some of the more offensive plays, the retail landscape, as that gets right-sized, NOIs get to a more sustainable level. I think valuers, the capital markets, will realize that in due course, and they'll see the relative value trade making a bit more sense. But even before that, I think the leisure travel, the hospitality landscape, you know, there's a lot of pent-up demand. Individuals, families, they missed out on their holidays in 2020. They're ready to get back to the beach. They're ready to get back into the sunshine. And I think there's going to be a strong, swift recovery in that, particularly for locations that individuals can drive to or are just a short train or flight away.
Really good to get your view on the outlook for the sectors. Thanks very much for joining us, Justin.
My pleasure. Thanks for having me.